When selling options, if you want to get the most out of your strategy, then I'd say it's imperative to know how to roll. And if you have no idea what rolling is, then in this video, you're going to have your eyes open to the power of rolling options. Rolling an option is simply the process of closing a current option position and then opening a new position at a new expiration date, new strike price, or perhaps both. So what the heck does all of this mean? Well, let's say that you sold a covered call. The current stock price was 40, the strike price on your covered call is 50, and then after a period of time, the stock price is starting to rise and it's getting close to that $50. Now, in this example, let's say you do not want the stock to go above 50 and expire above 50 because you have no interest in selling these shares. You want to continue holding on to them. So when you originally sold that covered call and collected premium, you opened a new position. You sold to open. As a result, your broker shows this position in your account as -1 contracts. In order to close this position, you now need to buy back 1 contract and then your position has been neutralized. And now you're free to write another covered call at a different expiration and strike price. Your old position has been closed and now you're going to open a new option position, let's just say 1 month into the future at a strike price of 55 compared to the old one of 50. And in doing this, you're able to collect more credit because this option is further out in time. It's further out of the money, moving up from 50 to 55, which means you'd normally collect less premium. However, by moving out in time, that additional time value allows you to still collect a credit. This helps you avoid being assigned on that option, forcing you to sell those 100 shares, and now you're able to increase your strike price and buy yourself additional time. Typically, when you roll covered calls, you're going to roll out and up. This means out in expiration and up in strike. In doing so, hopefully you'll still be able to collect a net credit, meaning more money is entering your account. With put options, when you're selling them, typically you roll them down and out, meaning down in strike price and out in expiration, or you could just simply move it out. Same strike price, just 1 month further in expiration. Now let's take a look at some examples of how to actually roll an option in practice. I'll give you guys a few tips that I think will really help you get the most out of your rolling. Here I've got my paper trading account loaded up with TD Ameritrade. I'll also be showing you an example at the end of this video of me rolling an option position in my real money account. Let's start off here by taking a look at our current position. As you can see, I have 100 shares in Snapchat and a current covered call position at the $37 strike price at the April 14 expiration cycle. If I go over to the charts here, we can see that Snapchat is currently trading for just under $36 a share. With this option that's going to be expiring here in about a week and a half, let's say, for example, I'm wanting to roll this. I don't want to encounter the risk that Snapchat could go above $37 a share prior to the expiration date, so I'll want to roll. There's a couple different ways you can do this. The first is that some brokers offer a rolling button. You can simply click on the position, click on create rolling order, and then it's going to create a ribbon up here that I can work off of. Some brokers offer this, some don't. Let's say, for example, your broker doesn't offer this. Instead, you can manually buy to close your current position and then sell to open a new position at the correct strike and expiration. Let's show you how that works here in TD Ameritrade. As I mentioned a moment ago, we're short 1 call option here at the $37 strike price. So I'm going to go ahead and create an order to buy back this contract. You can see this here, buying 1 contract, April 14th, $37 strike. And in doing this, I'm able to close this position, and then I'm going to sell to open another option contract at a different strike price. To buy back this contract, it's going to cost me about 99 cents. So let's say I want to roll my option contract as high as possible while still collecting a small credit. If we were to look here at the option chain, you can see that now I've got the May 20 cycle up. If I look at the prices here, I want to go to the highest strike price that still collects more than $1. And as you can see, that is going to be the $46 strike price. So I'm going to click on this button to go ahead and sell this option. And as you can see, once again, I'm buying back the $37 strike price and then selling the 46 strike 1 month into the future. This order should give me a 16-cent credit. This will be about $16 that enters my account as a result of rolling this option. I'm going to go ahead, confirm and send then send this order off. I should be able to see a fill show up here, and if it doesn't, I'll go ahead and adjust my order. It's not showing up now, so I'm going to go ahead and click on this button here. I'm going to cancel and replace this order. I'm going to move the price down to, let's say, 14 cents of credit. I'm going to confirm and send this off, and let's see if we get a fill this time. Oh, there it came. We got a fill at 15 cents. So we collected $15 in premium rolling this option out. Now, if I go back to the monitor tab, you can see I've got 0 position in the original strike, and now I'm short 146 strike call option. This is the process of rolling an option out in expiration and up in strike while still collecting a credit. Now I want to give you guys a few key pointers. I've gone ahead and neutralized the position, so now I have 0 option contracts in Snapchat and only my 100 shares. The thing that I want to point out to you first is when you roll your option is incredibly important. Should a person choose to roll that option prior to an option going in the money, or should I wait until after it's in the money? Let's take a look. In the previous example that I was showing you, Snapchat was trading lower than my strike price. The strike price was 37 and the share price was below 37. In doing this, I was able to collect a credit and move my strike price up $9 per share from 37 to 46. This is a pretty big jump. But let's show you what happens if you happen to have an option that is in the money. In this example here, I am now short 1 call option at the $34 strike price. Now, let's go ahead and see how far up we can roll the strike price while still collecting a credit. Back on the option chain here, I'm going to go ahead and buy to close the $34 strike price and then open one more contract at a higher strike price in the May 20 cycle. As you can see, it's going to cost me about $2.93 to close the current position, and then it looks like I'm going to be able to sell the 39 and still collect a small credit. If I went up to the 40, then we would end up paying a debit in order to roll. All right, I finally got a fill here at 30 cents. To highlight the difference here, when my option was still out of the money, meaning the strike price was above the current share price, I was able to collect a small credit and move the strike price from 37 to 46, $9 increase. However, in the second example, the option was in the money. I had the $34 strike price and I was only able to roll it up to the $39 strike price 1 month out, only a $4 increase. The further in the money your option contract, the harder and harder it becomes to roll up in strike and out in expiration. The reason for this is because at the money options have the most extrinsic value, and the deeper in the money you go, the less extrinsic value you have. As a result, it becomes more and more difficult to roll your option. If you take nothing else away from this video, always remember that if you roll an option just prior to it going in the money, you're going to be more effective at moving up the strike price for covered calls, or moving down the strike price in the case of cash secured puts. Whenever that option goes in the money, you're going to have a harder time rolling. This is something that I don't see many people emphasize, and I really want to point that out in this video. Now let's say if, for example, a stock price increases rather rapidly and you didn't have a chance to proactively roll that option prior to it getting in the money, and now you're stuck here holding a 33 or 34 strike covered call option, and you've got no choice but to roll. Typically, the goal is to roll 1 month out and increase the strike price as much as you can while still collecting a credit. However, sometimes you may be holding stock that you really do not want to sell. In some cases, it may be worth paying money to increase that strike price during your roll. In this case, you're going to have to pay a debit, but it may be worth doing this just to avoid the risk of having to sell those shares. You'll also want to take into consideration how much credit you've been collecting on this position over time. Let's say you've been selling covered calls on this stock for about a year and you've collected a ton of premium. It might be worth giving up a little bit of that premium that you've collected just to increase that strike price quite a bit more. Once again, selling options is a bit of an art and a science. Today I've shown you some of the math and the numbers behind why rolling proactively can be so beneficial, but it's also a bit of an art. You need to use a little bit of feel in deciding when you might want to roll, how much risk you're willing to take, and there may be other factors involved as well. The final thing I want to tell you guys before I show you an example in my real money account is that when you're selling options on companies of varying implied volatility, it's going to feel a bit different. Snapchat here is a very volatile company. As a result, the option prices significantly out of the money still have a lot of value. Rolling companies with high implied volatility is usually the easiest. If, however, you're dealing with a company that has relatively low implied volatility, options that are only 10 or 20% out of the money lose value very quickly. As a result, rolling options up in strike and out in expiration becomes a bit more difficult. Typically, you're not able to move the strike price as high as you would with a company with higher implied volatility. However, regardless of the volatility of the ticker that you are choosing to roll, the fundamentals all remain the same. The last thing that I want to show you guys in this video is rolling an option position in my real money account. Currently, I have sold 6 put options at the $25 strike price in Corsair Gaming. I am bullish on Corsair Gaming long term, so what I need to have happen is Corsair Gaming to get above $25 a share so that this option expires worthless. However, this option is going to be expiring here in less than 2 weeks, so I want to roll out in duration to give myself more time. So what I'm going to do is roll this option from the April 14th expiration cycle into the May 20 expiration cycle. On the right side here, we've got the put options, and right now this option is trading for about $4.05 or $4.10. When I roll this out, I'm going to need to buy to close this option and then sell to open that same $25 strike price in the May 20 expiration. This option is trading for about $4.45. In doing so, I'm going to be able to collect some premium. So I can go ahead and click on the ask price of this one and then click on the bid price of the one I want to sell. As you can see here, it's showing a 40-cent credit, and since I have 6 total contracts, I'll increase this over here to 6. I could go ahead and confirm and send this, but what I can also do is, as I mentioned before, TD Ameritrade offers a rolling feature, so if I went back to the Monitor tab, I can click on this button over here, bring up a rolling order, and it's actually going to bring up the exact same order ribbon that we saw a moment ago. I'm going to confirm this one more time. We've got 6 contracts. We're buying to close the April 14s and selling to open the May 20s. I'm collecting a 40-cent credit per option, meaning $40 per roll. I'm going to confirm and send this, and then send it off. As you can see here, I had all 6 orders filled, and now if I go back to the Monitor tab, you can see that the April 14th is now showing 0 contracts, and now the May 20 is showing 6. This is how you roll option contracts in your account. In the next video, we'll be discussing everything you need to know about implied volatility. It's an incredibly important topic and it's often overlooked, so you're not going to want to miss it. With that said, guys, if you've made this far in the video, thank you so much for watching. Don't forget to like the video, comment down below, and consider subscribing. Until that next one, peace.